Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, Head of Investment Strategy. With an objective to empower you with investment insights, on this program we discuss various perspectives that are shaping the global investment landscape. Financial markets have been worried about an inverted yield curve in the US for 14 months now. Inverted yield curve is one in which a short-term bond yields more than its equivalent long-term bond. For example, in the US, the 2-year Treasury bond yields circa 5%, while its 10-year equivalent yields circa 4%. Therefore, the yield differential between the 10-year and the 2-year is negative, and the yield curve is said to be in inversion. Currently, this yield curve inversion is prominent across developed markets like the US, the UK, and Germany, for example. So, why should we be worried about these inverted yield curves? For one reason, that they had a strong record of preceding recessions by anywhere between 4 and 24 months. However, our regular listeners would know that we held the view that the inverted yield curve this time is more reflective of the inflationary shock and the monetary policy needed to counter it, and less of a signal of a recession itself. Having lived in the inverted 10-year, 2-year yield curves for more than a year now, and with the curve inversion reaching its deepest level since early 1980s, financial markets continue to climb the wall of recession worry. The argument that is now being made by the market skeptics is that while yield curves invert before recession doesn't occur till the yield curve begins to steepen. Now, what is the steepening? Simply put, it is the uninversion of the yield curve. Also, a special situation of the yield curve steepening is bull steepening. This is when the yields fall across the yield curve segments, but they fall more at the short end of the spectrum compared to the far end. Now, markets start to wonder what could cause this so-called bull steepening of the yield curve from extremely inverted levels. We looked at the history and found that it is a central bank engaging in interest rate cuts that would trigger such steepening moves. In terms of financial market performance, bull steepening of the yield curves is less frequent but tends to cause weakness in risk assets and the US dollar. Looking at the last 30 years, we found 44 months of bull steepening of the 10-year, 2-year yield curve segment in the US Treasuries. The average performance of MSCI All Country World Index, our benchmark for equities, was negative 0.9%, while the global bond index rose 1.6% on average. The dollar index on average lost 1% over these episodes. During these months of yield curve steepening, volatility also rose for risk assets. However, looking at each of the 44 months of bull steepening in the yield curve, we found that all these episodes are not made equal. Only those that coincided with large economic stresses were bad for risky assets. For example, bull steepening occurred during periods of Russian financial crisis of 1998, dot-com bubble in 2000, 9/11 attacks in 2001, stock market crash of summer 2002, global financial crisis of 2008-2009, and the global pandemic of early 2020. Of course, periods of economic stress coincide with equity market losses and simultaneously with a rise in expectations of interest rate cuts from central banks, with the latter also triggering a bull steepening of the yield curve. Outside such major economic shocks, bull steepening of yield curves was more benign for equity market performance. For instance, in about half of the 44 instances of bull steepening, equity markets posted positive returns. So it's always important to put the yield curve dynamics into broader macro context. In summary, most Western developed markets have inverted yield curves, but they may not be sending an ominous signal. After having lived with inverted yield curves without a recession for more than a year now, the bearish camp has moved to watch bull steepening of yield curves, which tend to be triggered by central bank cutting interest rates and coincide with weakness in equities. However, our analysis shows that bull steepening of yield curves only during the time of extreme stress is bad for equities. So, given our more benign macro outlook and our view that central banks will cut interest rates next year as a part of the maintenance exercise and not due to a recession, we stay overweight equities and underweight fixed income over the 3-month horizon. Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. To get more information regarding how the changing dynamic of equities and bonds impacts your portfolios, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com. You were listening to the Global Investment Insights podcast from ADCB Asset Management, and my name is Kishore Muktinutalapati.